Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value, and I find a lot of value in answering your guys' questions in the comment sections or some of your statements that you read. I read through them, I'd like to answer them, and hopefully, again, this is just my opinion. Don't take it as 100% fact. And my opinion can sometimes be debatable. And that's where you want to listen to a couple different people, bounce ideas off of, hold many ideas in your head, bounce them off against each other, and do what makes sense to you. But my opinion, I've generated it over maybe 18 years or 15 years, 15 to 18 years of investing. I've formulated these opinions off of a lot of research that I've done on myself. It's been research based off of a whole bunch of different people, a bunch of articles that I've read, some books that I've read. But I try to really use my logic and knowledge and apply it to, I would say, not really economics, but to how people transact in the world. And usually I try to look for money flows, because money flows is what drives stocks higher and lower. It's not necessarily value. Value is where the money has gone. You're identifying where the money has left. Money flows is what really moves the asset or the asset price. Now, a couple of you guys made some comments here. I'd like to answer question comments. One of them is, Andy, if a pullback is expected and price action is pointing that way, and as a result, commodities could go down big, then what is the compelling case to stay in the market and not get out and sit in cash until the time where prices are stabilizing? Thinking of a possible scenarios, one could be that the market go sideways until the moving averages catch up. And in this scenario, commodities may have the chance to strengthen, I guess. But if there's a drop like we saw during last week, then we will be in deep red too. So if it's becoming more obvious that a crash or a large correction is in order, how do we best prepare for it? I mean, what if a correction of 50% or 70% happens? And I think that's a really good question. And what I did is, your buying point, your first buying point needs to be off of something that's a base. So you want to buy off of a large consolidating pattern or a base. And that's where I start to really load into companies. So for instance, I saw cheap valuations in oil, uranium, in copper, and all these different assets. They were creating these large basing patterns. And if you go back and look at my other old videos, you can actually see me charting out real time, giving updates and saying, look, these are big patterns that are breaking. And one of the things that I talk about on the channel, the quote is, monster patterns change lives. And monster patterns are the size of the pattern. They're big monster patterns. They usually take a decade or longer to develop. And then we break those patterns to the upside. And then what you see is a big move higher, and then you see a pullback, which is a retest or back test that I refer to all the time on the channel, especially even in the short term. So short-term price movements and how you read patterns or charts is the same as a long-term chart. Now, the big moves, the big money is made off the big patterns. Remember, monster patterns change lives. Now, if those monster patterns change lives, why are you worrying about the short-term movements? The short-term movements shouldn't shake you. Don't get shaken out of a stock and be left out on accident if you're going after the big move. What is your strategy? The strategy is a 5 to 10 year hold. It's not trying to time the market. It's little intricacy moves on the short term. Now, I want to talk about short-term movements. Short-term movements and being able to read the short-term movements have a lower probability outcome, technical analysis does. And this is my opinion. This is just my opinion. And people are probably going to I don't know if they're going to disagree or agree. Probably if people have been in the market and they've been doing a lot of technical analysis for a very long time, they would agree. But very short-term movements, like day trading, you're going to have a high probability that something could go wrong with a chart pattern, because the chart pattern can be moved so easily in the very short term. News can move something 10, 20% against you. An accident or something can happen very quickly, and it moves it in the short term a whole bunch in one direction that could be not favorable for you. Now, it's not as often to have a very large big picture structural change of news come out. So what happens is the big structural fundamental supply-demand balance and even the underlying fundamental structures of markets, like interest rate movements and dollar movements and inflation. Those are longer-term, big-term plays. Now, if you can identify the big, long-term market condition trends, the big trends of interest rates, inflation, commodities, and valuations, I should say valuations, not really commodities. Commodities are just low. But valuations, interest rates, and inflation. You get the big macro picture right, you will kill it. I mean, it'll be massive money coming into your account. It will be a flood of money coming into your account because what you're now doing is you're setting up a large asymmetric bet. What an asymmetric bet is, you can lose 50% of your money, but your upside could be 50x. What's worse, a 50%? I have to live through a 50% correction, which you can't really read very well on a short-term basis. Or you get a 50x on the downside in a couple of your investments. Doesn't mean you'll get it in your whole portfolio, but but you'll get it in some of your investments, and you'll just say, this changed my life. You know, $1,000 turns into 500,000 or more. I mean, it all depends on what companies and the returns. I mean, there's some of them returned 1,000, but it's pretty rare. A little bit more difficult to get those 500 or 1,000 bagger returns, but you could maybe do it against another asset. If another asset falls down while yours goes up 50 to 100 times, and that goes down, 50% or 90%, it could go down 90%. And from the valuations in the S&P 500 we have today, we could see stocks drastically pull back and commodities kill it. Now, there's some things that I've said this on the channel before too, that at some point the stock market could come back, and it's going to affect our commodity investments at the same time. But guess what? I don't know the correlation, and I don't know how big the effect will be. I think it will be affected, and I think it could potentially be a pretty big pullback. The question is, how fast does that other side crash? It may not crash as fast as we think, which then means that the margin calls and people selling, all this deleveraging that happens, may not happen as fast as we think it does. So then the question is a 50% pullback worse than missing out on a 50 times your money? Now, these things in commodities are volatile, and they can move very fast. There's times where I've seen a company double in a month, and it's like you just lost a huge amount of your cost basis by losing that move. And a lot of people, they don't want to buy into massive strength. They think they're chasing the stock, and they are chasing the stock. So what I do is I look for that basing pattern, the big base pattern. Comstock has a big base pattern right now, CRK. Just if you want to take a look at the chart. I'm not telling you to buy it. I'm not telling anyone to buy it on the channel. I'm telling you, just look at the chart, look at the basing pattern. That's the basing pattern I look for. And what I do is I put a little bit of money in. I just sprinkle some in. It's not a huge, 1 to 5% of my portfolio. That's all I'm putting in. I might put 0.5% in Comstock or 1%, and that's it. And then that basing pattern is where I get that nice low cost basis. And I just hold on. I don't care where it goes. If I lose 1% of my portfolio, it's not going to affect me too much. Or 0.5%. But if it does a 50x, that's big money. That's a good return. That's a very good return. It's very rare to find that. So I look for the basing patterns, I load up and do my initial big position sizing. Then I cost average in over time in comparison to my original positions, they're a lot smaller in amounts. I'm talking, let's say I have a portfolio, I do a 2, 3, 4% position, and I add less than 0.5%, like 0.25 or 0.1% in these little small cost averaging into them. And I try to cost average in at the best possible points that I can on a short-term basis. Short-term basis, and I want to go into this as well, short-term probabilities are much less successful than the long-term. The big chart pattern breaks, where they've got these big basing patterns, their probabilities of breaking, and when you see them break right off the beginning, like if they just break out, you have a high probability bet there, especially if you can see it across an entire sector. And then if you can see it across an entire sector, you can see it across other sectors that are all maybe under the commodity umbrella. it makes the case much stronger. It makes the case that we're going to have dollar weakness, that we're going to have rising interest rate environments, and all these things coming together. So if you see a base in interest rates, if you see a topping pattern in the dollar, if you see the basing patterns in commodities, and then you see it in all the specific companies all aligned in sectors, and they're all exhibiting this, you're seeing topping patterns in the S&P 500, in the technology companies, in the Dow. You're starting to tie it all together. You're becoming what I would consider to be a professional investor, taking into account all of those, the entire big picture of everything. Now, if you can take the big picture, the big macro picture, and tie it all together very well, and your time horizon is 5 to 10 years, and you say, well, how do you think a big pullback may occur? Remember, the short-term movements are less reliable. And if you get caught out, which I did on a couple of these stocks, they can move fast. This isn't like, go look at Athabasca Oil. Go look at SM Energy. SM Energy's up. I'm up 14 or 15 times my money it was in like six months. It's been less than a year. And are you going to be left out of a 14 bagger because you're scared? I turned, in my one account, I looked at that. I turned $5,700, and I think it's almost 90 grand in that one position. In other positions, I mean, they've gotten quite large. You put a couple grand in, and it's 14 or 15,000. Or you put in, maybe some of them are 3 grand, and you've got up to 12,000 in some of your accounts, and other ones, you know what? I put in a grand or two, and they're down 50% or 40%, and I'm looking at adding into them. Now, the play here, it's not about trying to make all of your positions winners. You're gonna have some that are laggards. You're going to have some that maybe not win. Now, a lot of people ask, well, what do you do with those losers? You let them ride. Let them ride. Because what if I'm wrong? If I'm down 40% in a position, and I think the company's strong, there's strong insider holdership, and let's say it's an exploration company. This thing's going to be volatile as heck. And let's say they hit something big. They kill it. They're down 40%, and then they go up 400% on your position, like this, because they hit something. Then it goes up another 400% on top of the 400%. Then it goes up another 400%. And then they look at it, and they drill down, and they say, this thing's huge, another 400%. Now you're up 20, 30 times your money. Why would you sell it if you were down 40% if the potential is so large? That's the asymmetry in this bet. You get the downside risk, and you got the upside potential. That's why you chose it in the first place. You didn't choose it because you were afraid of a 30 or 40% decline. You chose it, and you positioned your position size in your portfolio was correctly positioned, where it was only a 1% position. So then if you're down 40 or 50%, it's only 0.5% of your portfolio. You don't take big money and risk it on the exploration plays. I say this a lot on the channel. You take small money, sprinkle it out. Be smart with it. Take a 0.5% or 1% and take these positions out. Overweight the ones that you have more confidence in and that may have less risk but very good returns. Your risk-adjusted return. It goes back to that when I talk about it in other video clips. If you have a very low risk and a very high return, press that button, baby. I mean, physical silver, physical platinum. Huge upsides, very little risk. You're out of the system. Low tax risk, low nationalization risk, low everything risk. That's out of the system. And you could see very good upside potential. 8 times your money, 20 times your money, possibly. It could be a 20 bagger on physical silver or platinum. I don't know. But it's low risk. Then take your bigger diversified mining companies. Put some money in that. You can go a little bit bigger. They're diversified. They're big diversified commodity producers, basically. Your royalty companies are diversified by nature. They have all the price exposure, and they don't have that risk, the inflation risk, and they're diversified. You can have a whole bunch of different royalties. Lower risk, you can press higher risk button on it. And that's how I look at things. And the short term, guys, I can do all this technical analysis. You can have a perfectly pretty chart pattern that is about to break to the upside, and then some news comes out and blows it all to the downside, and it's like, what the heck just happened? That's on the short term, but on the long term, more than likely is going to turn and come back up. So and remember, I'm also, when you guys are like looking at these things and I'm trying to help everyone, you have to look at it from my perspective as well. I'm trying to help you guys become better investors. An investor is a long-term approach. Trading is much more difficult. And if I try to have everyone on the channel try to time this, then you guys are going to have to be watching every single second of every single move. And it's going to be incredibly stressful for you and for me to try to time all this out. The best, easiest way with the highest probability of it becoming a very big, we'll call it very big returns, is getting the big picture right, getting in the undervalued investment and just holding on, and then slowly cost averaging in when we see these pullbacks, which could be a 50% pullback. But if you could see, you're looking at it from a 50% pullback from your original position, which it could happen. But what if you're up 500% and it pulls back 50%? And how much does this stock have to pull back for it to be worthwhile to actually sell it and pay short-term capital gains? If I have to pay a 20% capital gain tax on something, I may have to have the stock pull back more than 20% for it to even break even if I have to pay taxes on it. Now, that's only on the profits. I get it. It may be a little bit less. Maybe it's 10% or 5%. Depends on what your profits are at that time. And how much it went up. But sometimes it's not worth it. You're going to have a 10% or greater pullback for you to break even. Why risk it? Why pay the taxes on it? You're just going to make the government rich, not yourself, unless you're in a tax protected account. Even so, I wouldn't do it, because you could have an okay chart pattern develop and then this thing just takes off. You could have consolidation patterns run upward, not downward. You can consolidate upward or sideways. Sideways or up, and you're not really losing anything. So if you sell out, you have to pay taxes on all your profits, and all it did was go sideways. That's a risk. Now, next year, you have to sell some of that and pay taxes. So I don't, looking at this big picture from a risk-reward perspective, take the big picture view, get the macro as best as we think we can get it right. We know the valuations are cheap. That's a fact. Commodities are cheap. Fact. They're putting in these massive patterns. Fact. Now, is the macro completely right? That's debatable. We can there's going to be a whole bunch of channels that debate the macro perspective. Some will say deflation, some will say inflation. With the valuations where they're at on the upside for stocks, overvalued, and the downside for commodities, I know the money is not in commodities, and I know the money's in stocks. That's a fact. We can see it in the valuations and the ratios of our values. Now, the macro trend, I see a housing market that's going up in an expansion phase. That is a fact. The short term, and inventory is at all-time lows. Fact. So we've got these facts here. Now, I think that it's going to be inflationary because that's what history has shown in a real estate boom, and that is a fact. So now the debate is the real estate expansion phase going to continue? I think it is, based off of the housing deficits. Other people disagree. They think the moratoria and the forbearance is going to break that relationship. They think that we're not going to be in an expansion phase and it's going to come down. I think the momentum's to the upside. I don't even think the moratoria is going to break it, but you know what? I could be wrong there. That is a debatable. That's not a fact. That's not the expansion phase, and how big that expansion phase that I think it's going to be is not a fact. That is an opinion. And that's where the debate can be had. But given everything and what I'm seeing and the chart patterns that are breaking to the upside, I'm playing the big picture. I don't want to try to trade in and out. I've been wrong in the past. And for me doing this with a bunch of people watching it, it's going to put far too much pressure on me. It's better to play the big picture view, to hold on and not worry about it. Go do your work, go focus on your work. And then we can look at the valuations, we can look at the trends, and then we can make decisions based off that from a long-term perspective. That's the way I view it. If you guys disagree, please put it in the comments section. I know this has been a pretty long answer, but I don't want to get in the short-term game because I've lost trying to do the short-term game. I think the long-term game can return very, very well. And I know for a fact that the valuations are cheap for commodities and commodity type companies. If you guys like this, please give me a thumbs up. Help me out. And thank you for listening. This is Finding Value.